Good afternoon. Welcome to Mid-Cap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. Well, we did see some recovery from the lows that has been sold into, but the mid-caps are doing well, and we have a lot of market to talk about.
Absolutely right. The broader end of the market is holding up, but quite a bit of selling pressure, especially in the last half hour of trade. Quite an action-packed show. Let's start off with the top headlines. Mid-caps clock good gains even as frontline stocks trade in a narrow range. FMCG, realty and metals gain, but consumer durables, healthcare and financials drag.
Lakshmi Organic surges almost 7% in trade after it reported strong earnings in Q2. Revenues are up 18%. EBITDA jumps 92% on a YOY basis. There's a sequential recovery as well.
Honeywell Automation falls over 7% after revenues decline. Margin comes under pressure in Q2. Nuvama retains its reduced rating on the stock, say they see no upside potential and more risk than reward.
Five-Star Finance comes under pressure despite reporting a strong quarter as the management cuts FY25 growth guidance to 25% from 30% earlier. The company also announces interest rate cuts of 200 basis points.
Concord gains in trade despite a subdued set of earnings in Q2 FY25. Management tells CNBC-TV18 they maintain FY25 EXIM volume guidance of 15 to 25% for the domestic as well as overall volume guidance of 18%.
Okay, all right. Those are the top headlines for the markets. As we've been pointing out, it's a 70-point cut that we're seeing on the Nifty currently. It's off the highs of the day. The mid-caps, they're doing well. Of course, that pocket has been outperforming the broader the benchmarks today, but that too has come off from the highs of the day. Bank Nifty is the one which is seeing some profit booking after that stellar move that we saw yesterday on this index. That one down 450 points. And if we talk about sectoral movers, not many in the green today, I mean by a big margin. We do have the Nifty Media, Nifty Auto making a comeback, the FMCG space doing well. The small cap index is also outperforming with gains of around 1%. But a lot of stock-specific move, and that is something we'll discuss now.
That's right. Just before we go to Pharma, a couple of stocks to keep on your radar. The first one, of course, is MCX. In the last hour, you've seen significant selling pressure. Pharma is standing at the wall. Pharma's whole host of stocks that's on your radar. Which are the ones in the broader end of the markets making the moves?
Broader markets indeed doing well for themselves, and Poonawalla Fincorp is among the top gainers within the broader market space after the drubbing that it saw after results, and it is now seeing a bit of recovery. 9% higher on the stock is Poonawalla Fincorp. Some other names like Cochin Shipyard, Phoenix Mills, Mankind Pharma also doing well for themselves. Earnings reactions are on both sides of the spectrum in today's trading session, both good and bad. Force Motors is in a 20% upper circuit after results. Reddington also having a good day, but 5-star, as you just highlighted in the headlines, 12% lower, and not a good day for Honeywell as well at the low point of the day, now down 8%. Railway PSUs are doing well for themselves, and it's been a while since we spoke about them. IRFC, IRCON, RVNL, all of them seeing gains of anywhere between 6 to 10%. Stocks doing well on the back of very strong volumes, and Capri Global is one of them, 15% higher on very strong volumes. Data Patterns, ITI, Polymedicure also seeing very healthy gains on strong volumes. And lastly, some other underperformers include the likes of MCX down to the lows of the day, 7% lower. Chennai Petro and Amber Enterprises too seeing some bit of profit booking today. Back to you guys.
Okay, all right. Thank you so much, Harmas, for joining in. As always, focus. By the way, if we talk about some of the stocks other than what Harmas spoke about, because we've been getting major earnings reactions as well. Force Motors, for instance, that stock is logged in. Reported strong set of numbers, and that stock is doing well. Lakshmi Organics is the other one which is doing really well on the back of good numbers. It was a sequential and on a YOY recovery. Commentary was very strong. They expect the growth to continue. They've increased their growth guidance to 25 versus 20%. So that is doing well for the stock today as well. But we have some other companies. Managing Director and Group CEO of Swiggy, along with Rahul Bothra, who is the Chief Financial Officer at the company, and began by asking them about the sustainable growth on top line and path to profitability for food and.
In the food delivery business, we turned profitable, not only at the contribution margin level, but at the EBITDA level. In terms of the overall platform growth has been very strong for us over the last 3 years, growing at 32% and scaling well. So overall, we are very happy with the trajectory that each of the businesses are demonstrating.
Right, but you're not saying what the street wants to know, because, you know, while they have turned contribution positive for the food delivery business, and they say on the street, and EBITDA. On the street, they say, ye dil mange more, right? Now that you're listing, you also have a listed peer. With the trajectory that we've seen on them, on a lot of the parameters, they're above, you know, what Swiggy is right now, which is not to say that you're any less, it's just that you're at different stages of growth in your life.
Correct. I think, look, there's a lot of context. We each have our own context, and we are in very, very exciting categories. And our strategy, our capital allocation, everything's going to be a function of our excitement and what we can go after in each of these. Like Rahul mentioned, we've demonstrated the profitability in the food business. We feel good about its future going forward. As for quick commerce, I think it's in a once in a lifetime category, and I think we are seeing consumption patterns change for consumers, and there's so much to be done. So our endeavor will be to make sure that we do the fullest of our ability to make sure that we grow and, you know, serve customers well and make sure that everything comes together nice.
But, you know, for quick commerce, you recently said that the, you know, peak of the investment is behind you, but you're still not a contribution margin positive either. So, I mean, what is the trajectory there for quick commerce? Because even for your peer, that has been the growth driver. Right. So how are you looking at the quick commerce business for you in terms of being, is it also going to be the growth driver for you? And sort of trying to get a sense of the path of profitability on that front also.
See, maybe I'll take this. See, I think on quick commerce, you know, what really amazes us is the way consumers are reimagining, you know, things, or what can we deliver to them. So it's almost like every quarter we have to recalibrate around, you know, what is the number of categories that we have to be there, what is the number of SKUs we have to launch, and there's a recalibration happening. Growth is accelerating. So there'll be a certain amount of, say, new store additions that we'll continue to do. The old stores continue to mature well, which means that they become profitable over a period of time, and the new stores come in because consumers want a lot more. Right. So I think it's a recalibration of, you know, our overall growth trajectory in line with the demonstrated path to the contribution margin that we will demonstrate.
So let's get a little more specific now. As of the first quarter, you had around 557 e-commerce, quick commerce dark stores. How many of them are mature? How many of them, and mature stores, what is the contribution margins that they do? If you could give us that sense. And you are doing about 980 or closer to 1,000 crores in terms of dark store expansion. So what's the aspiration there? How many are you looking to add? And over the next couple of years, what's the milestone target that you have?
Now we will, you know, give specific numbers and not just directional numbers when we can. Currently, there are regulatory constraints that we cannot talk about. But to give you a sense of, you know, how are we, you know, planning our overall store expansion? I think store expansion is a derivative of growth, and, you know, not otherwise. It's not like we want to add number of stores, you know, which is ahead of even the growth journey. So, you know, calibration will happen according to the growth of the category.
What proportion of your stores are contribution positive? If that could...
We will give it in our first earnings call.
But I mean, at least in terms of maturity where we are, we're looking for some color on that front.
I think you're trying your best.
All right.
Okay, let's try it this way. How much does it cost to open one dark store?
So in terms of, you know, the overall capex requirement, it could vary depending on the size of the store, but anywhere between 65 lakhs to 85 lakhs is what, you know, we have seen.
So roughly 986 crores is what you're putting out for a dark store expansion. 65 to 85 would imply closer to 1,500 dark stores over the next 18 months or 20 months, depending on the rate at which you deploy it. Would that be a fair assessment? You're not saying anything. I'm just doing the back of the envelope.
I think, see, the overall time to market of, you know, deciding to start a store and then launching it is actually less than a quarter. So I think we are in an agile world. I think, as I said,
so less than 1,500 stores adding in less than 4 quarters. That's the headline that we got.
Consumers are reimagining, and we are definitely going to deliver what consumers are.
How do you see the competition for the quick commerce space, and do you think there is space for 5 to 7 or more players, you know, down the line? How do you see this market settling, and, you know, how are you looking at the competitive landscape right now?
Okay, cool. See, I think at the outset, I'd like to maybe start by saying that there will be multiple players in any large market that you go after, and I think quick commerce is no exception. So there will be multiple players at the end of it. It's not going to be a winner-takes-all market. The next one is, as for, let's say, you know, multiple players, etc., every category. Now, if you go back and trace back, even in the food delivery business, there have probably been like 25 competitors. Today, it doesn't look like it. Feels like a long-lost memory. But I think many folks will play, and the ones who are, building sound, sustainable businesses while serving consumers well will come out on the other side looking good.
Food delivery business, right now we've seen it's just we just have Swiggy and Zomato that is really able to. It's become a duopoly. How do you see the quick commerce that way?
Like I said, I think if you just go by market structure, it is a function of market size. And if, let's say, the quick commerce market is going to be larger than the food delivery market, it will probably be able to serve more than 2 players. Whether there will be 2, 3, 4, I don't have crystal ball, so I think we just keep doing what we can.
On the food delivery business, you've turned positive. Over the last 3 years, we've seen that J-curve effect play out as well. Contribution margins closer to 6.5% right now. The peer at a larger scale is doing a little around 7.5%. What is the steady state contribution / EBITDA that one should look at when they look at the food margin?
No, I think we again can't give specific guidance here, right? But I think from the overall industry standpoint, there are industry reports that suggest that this could be a 5% EBITDA business.
Got it.
And I think the contribution margin trajectory will.
And your current EBITDA in the food business would be?
So we delivered a 0.8% in our Q1.
Got it. So there is chance for this to quintuple from here, from 1% to about 5% over the future as it
there is obviously the contribution margin expansion journey as well as the operating leverage. What happens in platform businesses is that once you hit a certain scale, the incremental fixed costs that get added is significantly lesser than the overall scale benefit that happens. And we will demonstrate both operating leverage as well as the contribution margin expansion.
A lot on the street thought that you would come at a value much higher than what actually has happened. How much of the discussion happened during that time, and what led to your valuing your company at the numbers that you did as against what was earlier perceived?
See, I think we were, both Harsha and I spent a significant amount talking to investors over the last 4 weeks, as you can imagine, in any IPO roadshow. We heard the sentiment. It was a fair price discovery process, and I think investors have given it a certain price, which is what we have come out with. I think it's ultimately for the street, for the retail investors out there to decide.
A very interesting conversation there with Swiggy. Now moving on, let's now slip into a short break. Parvaz Srinivas Reddy from MTAR Technologies joins us next to discuss their Q2 performance and the way forward. Stay tuned. Welcome back to Midcap Radar. Well, some selling pressure emerging in the last 15 minutes of the session, but MTAR Technologies is the next management on the show. The company reported a stable set of Q2 numbers. Revenues came in healthy while EBITDA margin contracted on a year-on-year basis. We have Parvaz Srinivas Reddy, the Managing Director and Promoter of MTAR Technologies with us. Good afternoon, Mr. Reddy. Thank you so much for joining us. First up, when we talk about FY25, the guidance, at the start of the year, you had given a guidance of 30 to 35%, which was earlier trimmed from 40 to 45%. So at the end of Q2, which is sequentially much better compared to Q1, where does the guidance stand, both on the revenue as well as margin front? We understand you had given a guidance of 22 to 26% as far as EBITDA margins were concerned.
Yeah, so we had mentioned that we'll do 30 to 35%, but we looked at more closely for this year, and we said we should be around 725 crores of revenue for this year with about 21% EBITDA margin. That's what we're looking at. Okay,
so that means there's a further cut. You will be able to do around 25% of revenue growth with around 21% margins this year. But Mr. Reddy, halfway mark, you're absolutely flat. So are you saying second half you'll be able to achieve the rest of that 25% revenue growth guidance? What will be the driver for that? What makes you so confident?
No, we have a lot of projects which we are working on both in the nuclear and the aerospace sectors, and the kind of forecast we have been given for the clean energy as well. So looking at all that, we are pretty confident of having a better second half than the first half. We have caught up with the momentum right now with Q2 as well, and we should be able to achieve the numbers what we're saying as a guidance of 725 and 21% EBITDA. And also, the reason for 25% is that we are working on a lot of first articles, qualification processes are going on. So we're looking at all this for the future growth for the next year as well. So we are focusing on the future for the company in terms of various products that we are realizing in the current year, which will add to huge volumes for the next year.
Mr. Reddy, order inflows this time around, they've gone up by almost 250 crore. But what's a little concerning is the fact that the order backlog has actually dropped a little over 5.5%, coming in at around the 940 crore. So are you saying in H2 you are expecting to see some significant order wins coming in? And when we talk about Bloom as well as Fluence, last time you had mentioned that there are some significant orders expected from them. So what is the status on that?
We are expecting significant orders from Bloom in this quarter itself. And also, if you remember, we said we are expecting more than 500 crores plus orders from nuclear division as well. So these are expected in the second half of the year. So we are looking at, once these orders come in, and also from the MNC aerospace business, we are looking at close to about 1,400 crores of closing order book by end of this year.
Okay.
So expecting another 450 crores worth of order inflows in the second half of the year. So Bloom, can you quantify the the quantum of the order that you're expected from Bloom? And Fluence, you said around 400 crore. Is that accurate?
No. What I've said is that Bloom would be around 200 to 250 crores of additional orders coming in. Apart from that, we can get more than 500 crores of orders from the nuclear division. So net of, by end of this financial year, post the sales, we are looking at about 1,400 to 1,500 crores of closing order book for FY25.
Okay. So that will be the order book. Can you give us a sense of what the split will be like? How much is going to come from clean energy, say, in the next fiscal? Because that continues to be the big focus point for you. And in that case, would margins change? Mr. Reddy, you spoke about this year, but if we take it forward to the next year as well, how much would clean energy contribute? How much would come from nuclear? And are these high margin segments for you?
Yeah, next year, as I said, we are sequentially, the margins are improving quarter on quarter basis. And we should move to a level of, for the FY26, we should looking at about 24% margins plus minus 100 basis points. And clean energy would contribute in the revenue segment around 40 to 45% because we are growing very rapidly on the aerospace division and the nuclear division as well for next year.
Mr. Reddy, you did allude to nuclear energy. You did allude to the fact that you're expecting to get a few orders there. What has been the execution as far as that particular segment or that particular vertical is concerned? When does that start contributing as far as the top line is concerned?
I think majority of the execution would start from next financial year. And to top it, whatever existing orders we have for 140, 150 crores, we also expecting, as I said, close to 500 crores worth of orders. So it would contribute a lot to the top line moving forward from FY26.
Okay. All right, Mr. Reddy, we take that point. Thank you so much for joining in today with that take and what the outlook is looking like. Positive outlook, but yes, the guidance has been cut on the revenue growth and margins this time around as well. By the way, just a while back, there were important flashes at the bottom of your screen. Sources were suggesting that the Department of Telecommunications, it has floated a draft cabinet note seeking bank guarantee waiver for telecom companies, and it is for spectrum, which has been acquired prior to 2022. And this is something that a lot of these companies had spoken about as well. Vodafone Idea definitely will be in focus on the back of this. The stock continues to be under pressure. Bharti Airtel is absolutely flat with some negative bias right now, but Vodafone Idea continues to be where it was, down 2.5%. But of course, we'll get you more updates on this story. For now, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. Well, as you can see, Nifty is closer to the day's low. It's a 102-point cut that we are witnessing right now. The Bank Nifty is the one which is pushing the Nifty lower. So the likes of HDFC Bank, Kotak Mahindra Bank, both these names are the ones which have led to the fall that we've seen from the highs. Mid-caps still outperforming, but that has come from off from the highs of the day as well. So not looking like this recovery has continued, but we'll do one thing. We'll take your leave on this edition of Mid-Cap Radar. Stay tuned. Your stocks when we return, and we'll take all the market action ahead.